Want to know which investment could secure your future? REITs or bonds? Today, we're diving into a comparison that could change the way you think about your portfolio. Investing can feel overwhelming, but with the right insights, it doesn't have to be. So, let's break down REITs and bonds in a way that's easy to understand and packed with actionable advice. Imagine this. You just come into some extra cash and you're trying to decide where to put it. Should you play it safe with bonds or take a chance on REITs? Both have their merits, but they serve different purposes and come with different levels of risk and reward. Let's start with bonds. Think of bonds as the reliable friend who always shows up on time, steady and dependable. When you buy a bond, you're essentially lending money to a government or corporation for a set period, and in return, they pay you interest. It's a pretty straightforward arrangement. If you're someone who values stability and a predictable return, bonds might be your go-to. But here's where it gets interesting. While bonds are safe, their returns can be limited, especially in today's low interest rate environment. You might earn a modest 2 to 3% annually, but if inflation rises, your money could lose purchasing power over time. So if you're planning for long-term growth, you might want to consider how that plays into your financial goals. Now let's talk about REITs, or real estate investment trusts. Imagine a bustling city full of skyscrapers, retail spaces, and apartments. REITs allow you to invest in real estate without having to buy a whole property. You're essentially buying shares in a company that owns, operates, or finances income-producing real estate. The beauty of REITs is their potential for higher returns. Historically, they have outperformed bonds, offering returns of around 8 to 12% annually. However, remember that with higher potential returns comes higher risk. REITs can be more volatile, fluctuating with the real estate market and economic conditions. If you're investing in a REIT during a market downturn, you might feel the pinch more than you would with bonds. Let's put this into perspective with a relatable example. Imagine you invested in a bond yielding 3% 5 years ago. Your investment is stable, but over those 5 years, the purchasing power of your returns has been eroded by inflation. Meanwhile, if you had invested in a REIT during the same period, you might have experienced ups and downs, but on average, your returns could be significantly higher. So, how do you decide which option is right for you? Here are 3 key factors to consider. Risk tolerance. If you're someone who can't stand the thought of losing money, bonds might be your best friend. But if you can handle some ups and downs for the chance at higher returns, REITs could be your ticket to greater wealth. Time horizon. If you're looking for a short-term investment, bonds offer stability and consistent returns. But if you're in it for the long haul, REITs could provide the growth you need over time, as the real estate market tends to appreciate. Financial goals. Consider what you want your money to do for you. If you're aiming for a stable income in retirement, bonds can be appealing. But if you're seeking to grow your wealth faster, REITs may align better with your ambitions. Here's the takeaway. Both REITs and bonds have their unique advantages and drawbacks. They can even complement each other in a well-diversified portfolio. If you prioritize safety and steady income, lean towards bonds. If you're excited about the potential for growth and can weather the storm, REITs could be your best bet. So, are you Team REIT or Team Bonds? Drop a comment below and let us know your thoughts. And don't forget to subscribe to Best Advisors for more insightful content like this. Next time, we're covering a unique investment opportunity that many overlook. Don't miss it. Remember, investing doesn't have to be intimidating. With the right knowledge, you can make informed decisions that pave the way for your financial success. See you in the next video.